Welcome to the Cycle Framework Insights podcast with Chief Strategist Brian Jordan. Hello, this is Miriam Rush from the CFI Podcast with a new episode on the topic of elections. I am joined once again by our own Brian Jordan to look at how the economy has influenced election outcomes and how elections in turn may have influenced economic outcomes. This is a subject that is very much on the top of mind these days as the 2024 presidential election campaign heats up. So, Brian, let's get to it. It is often said Americans vote their pocketbooks, but how much does the economy really drive election results?
The history is very clear here that Americans do, in fact, vote their pocketbooks. When the economy is growing, the incumbent party generally wins the election. When the economy is contracting, the incumbent party rarely wins the election. In fact, as we've detailed on a prior podcast, we have data on the business cycle going all the way back to the 1850s. And in that time, there have only been two cases in which the incumbent party held on to the White House when the election was held during a recession. And both of these cases were curious outlier cases. The first was in 1876. This was the famous disputed Rutherford B. Hayes election, in which Rutherford B. Hayes lost the popular vote, but was still awarded the presidency in the Compromise of 1877. That election was held in a recession, and the incumbent party still won. The second case was in 1900. That's also the most recent case in which the incumbent party held on to the White House in a recession. And this was the re-election of William McKinley. And this is a curious case as well because the NBER says that the U.S. economy was in a recession in the year 1900. But we don't have a lot of data. The data is very sketchy that deep into our history. And in fact, McKinley ran on a platform of economic prosperity. He ran on his economic record. His slogan was 4 more years of a full dinner pail. And in fact, his challenger in 1900, William Jennings Bryan, acknowledged that the economy was doing well, acknowledged the full dinner pail appeal, and instead argued that we want more than a good economy. We want a shorter work week. We want representation for labor in the president's cabinet. And so that was called a recession, but may not have been a true recession in the way that we think of these downturns today. Since then, we haven't had a single case in which the incumbent party has won the presidential election when the election was held in a recession. On the flip side, the incumbent party generally wins when the election is held during expansions. In the middle stage of an expansion, in fact, if we break down these cycles into beginning, middle, and end, in the middle stage of expansions, the incumbent party has won over 90% of those elections. In fact, only one incumbent lost in those cases. That was Gerald Ford in 1976. The economy was barely into the middle stage of that 1975 to 1980 expansion. At that point, Ford lost a very close election. So the moral of the story is if you're the incumbent, if you're in the White House running for re-election, you don't want to run in a recession.
Wow, that's really interesting historical perspective. But let's drill down a bit. Are there any specific economic trends that have larger influences on election outcomes?
There are a couple, and these shouldn't come as surprises. First of all, the labor market. As would be expected, a strong labor market favors the incumbent party. A weak labor market favors the challenger party. So when the unemployment rate has risen in an election year, the incumbent party on average gets 44.1% of the popular vote, just 31.3% of the electoral vote. And in fact, the incumbent party has never won. Now, we only have data on the unemployment rate back to the 1940s, but in that time, the incumbent party has never won a presidential election when the unemployment rate has gone higher in the election year. Conversely, when the unemployment rate has fallen in an election year, the incumbent party wins 51.8% of the popular vote and 63.4% of the electoral vote. A strong labor market, no surprise, is good for the party in power. Longer term, across the presidential cycle, inflation is key. When inflation has fallen during a 4-year presidential term, the incumbent party tends to win again. When inflation has risen across a 4-year presidential term, the incumbent party tends to lose. And here again, there's only one case in which the incumbent party has won the White House, held on to the White House when the inflation rate has risen across the 4 years. This was in 1972. This was after President Nixon instituted wage and price controls in 1971. These controls were successful. These freezes were successful in temporarily reducing the inflation rate. The inflation rate had been above 6% in 1970, had fallen to below 3% by mid 1972, the election year, just a few months before the election. And so over the 4 years, inflation was higher on average, but it was falling going into the election. Nixon, of course, won re-election handily in 1972, and these wage and price controls were very popular, at least amongst the public. One poll at the time showed that 75% of Americans were in favor of these controls. Not so popular among economists, but popular amongst the public. So this was the one exception in which inflation rose and the incumbent party still won. Otherwise, higher inflation favors the challenger. And of course, in the shorter term, in the election year, a higher unemployment rate favors the challenger as well.
Wow, that's incredibly interesting, and I think it'll be interesting to pay attention to how these economic data points shake out, especially as we get closer to the next presidential election. But let's talk about the stock market. More than half of Americans have equity investments. So does a strong market tend to help the incumbent?
In general, yes, but the correlation is weak. The correlation between the stock market and election results is not nearly as strong as the relationship between the labor market and election results, or GDP growth and election results, or the inflation rate and election results. So we've had some cases where the stock market has been weak and the incumbent party has won. We've had some cases where the stock market has been strong and the incumbent party has lost. So for example, in 1976, the S&P 500 was up by nearly 20%, and Gerald Ford still lost the election. Just 4 years later, again, a very strong stock market in 1980. The S&P 500 up by 25.8% in 1980, and yet Jimmy Carter still lost in a landslide to Ronald Reagan. And so, in general, yes, there is some relationship there. It's not a very strong relationship. More important to pay attention to those real economy variables, GDP, job growth, unemployment, and especially inflation.
Noted, noted. So let's shift gears a bit. We've talked about the influence of the economy and the market on the election, but what about the reverse? Does the economy behave any differently in an election year?
So there is some evidence that the economy behaves a bit differently, that there's a bit of a lift in economic growth. There is this long-held belief that presidents try to support the economy in an election year. They spend more money. They're willing to push the deficit a little bit higher, the budget deficit a little bit higher, and that's proven to be true historically. So if we go back to the early 1970s, on average, the budget deficit in the election year comes in a little bit above 3% of GDP. That is the highest on average across the presidential cycle. In year one, it's around 2.8%, year two, around 2.8%, year three, a little bit less than 3%, and then again in year four, a little bit more than 3%, the highest across the presidential cycle. And we've averaged, on a GDP basis, we've averaged pretty healthy growth in the election year, a little bit over 3%. Now, the strongest year historically has been year three, when GDP has averaged 3.5%, but these are both stronger than years one and years 2. So there is some evidence the economy picks up a bit in an election year, partly because, perhaps in large part because, the deficit gets a little bit stronger, a little bit higher in the election year.
Okay, so let's move into the future a little bit. What about after the election? How quickly does the economy change in response to changes at the White House? And when an incumbent wins re-election, how different is the second term from the first term?
So GDP does slow on average as we go from year 4 of the presidential cycle to year 1 of the next presidential cycle. Um, we see a little bit, on average, a little bit less than 3% GDP growth in year 1 of a presidential term. And again, that's versus 3.3% in year 4 of the previous term. So there is, on average, a modest slowing in economic growth as a new cycle begins. But when we've had an incumbent reelected, we tend to see very similar growth rates from year 4 to year 1. Dwight Eisenhower, for example, in year 4 of his first term, GDP grew by 2.1%. In year 1 of his second term, it also grew by 2.1%. And there are many other examples along these lines. Lyndon Baines Johnson, LBJ, the year 4 of the Kennedy Johnson presidential term, we had growth of 5.8%. Year 1 of LBJ's next term, 6.5%. Very similar, strong growth. Richard Nixon, 5.3% in year 4 to 5.6% in year 1. George W. Bush, 3.8% to 3.5%. Barack Obama, 2.3% to 2.1%. These are very similar numbers. GDP is not changing all that much from year 4 to year 1. So we don't see these big changes as the presidential cycle turns. And a big reason for that, many of our long-term followers of our work will guess where I'm going next with this. A big reason for that is we, in most of these cases, have continuity at the Federal Reserve. So we have a new presidential term, or in some cases, we have a new president. But in most of these cases, we have the same Fed chair and mostly the same Fed Board of Governors. We have a steady monetary policy. And so the economy tends to move relatively steadily. So we see some minor changes on average, but not big changes as we go from one presidential term to the next.
Fabulous. So let's wrap this up. And I think this is really the point our listeners want to hear from us. What can we expect in this election year and beyond? And what does the data say about the likely winner in November? And how might that result influence economic performance in the years ahead?
So the data is pointing in one direction here. Now, every election is different. There are always different issues that arise in a presidential election. So there are no guarantees. But the data is pointing in one direction here. So we mentioned earlier that the labor market in the election year is very important, especially the movement in the unemployment rate. When the jobless rate goes down, the incumbent tends to win, on average, winning over 60% of the electoral vote. When the unemployment rate rises, the incumbent party wins an average of just over 30% of the electoral vote. And in fact, the incumbent party has never won, going back to the 1940s, in a year in which the jobless rate has risen. Now, the jobless rate has trended up this year, so that doesn't bode well for the incumbent, for President Biden. Very similarly, we mentioned the longer-term influence of inflation. When inflation moves up over the course of the 4-year cycle, not just in an election year, but over the course of a 4-year cycle, that typically spells bad news for the incumbent. And of course, in this case, the CPI inflation rate has moved higher in this presidential term versus the prior presidential term. We've only had, as we mentioned before, only one case in which the incumbent party has won when inflation has risen. So those numbers are pointing very much towards the challenger in this case, that we would see former President Trump winning the election in November and the Republicans taking control of the White House. Now, what does that mean for the economy going forward? Well, we're only in May at this point of election year 2024, but we've already seen many, many stories about the 2024 presidential election. But one very underreported story, and one I expect to remain underreported as we move towards the election and beyond the election, is the fact that in terms of economic policy, Presidents Trump and Biden have, in many cases, been in lockstep. So, in response to COVID, President Trump at the time pursued two major fiscal stimulus packages and passed, signed into law, two major fiscal stimulus packages. Soon after President Biden was inaugurated in 2021, he also signed into law a major fiscal stimulus package. Both presidents responded to COVID and the COVID recession with massive fiscal stimulus. President Trump, of course, initiated and signed into law major tax cuts, both individual tax cuts and business tax cuts. President Biden has kept those tax cuts in place. President Trump initiated tariffs on Chinese imports. President Biden has kept those tariffs in place. Um, President Trump at least came into office with the intention of pursuing major infrastructure spending. Didn't come to fruition during President Trump's term, but President Biden, of course, signed into law major infrastructure investment, major infrastructure spending. Most importantly, getting back to the point we made earlier, most importantly, President Trump appointed Jerome Powell to be the chair of the Federal Reserve, and President Biden also appointed Jerome Powell to be the chair of the Federal Reserve. So continuity at the central bank, that typically means continuity for the economy, and we've seen this play out historically in this way. That you see a change in the presidency, but you see a steady hand at the Fed, and so the economy, at least in the moment, in the cycle, doesn't tend to change all that much. President Carter, for example, appointed Paul Volcker. President Reagan reappointed Paul Volcker. At least in the near term, the economic trajectory stayed largely the same. President Reagan then later appointed Alan Greenspan. Greenspan was reappointed by President George H.W. Bush and then reappointed again by President Clinton. Steady hand at the Fed. George W. Bush appointed Ben Bernanke. Barack Obama reappointed Ben Bernanke. And then again, Donald Trump appointing Jerome Powell. Joe Biden reappointing Jerome Powell. So the moral of the story is, as long as we have a steady hand at the Fed, we shouldn't see major changes, even if we have a change at the White House. That should be especially true in this case, given that, at least in economic terms, at least in terms of fiscal policy and in terms of trade policy, we've seen very similar stances from the Trump administration and the Biden administration. So we may very well see a change in November. Don't expect that to mean a major change in the economy in 2025.
Wow, that's interesting perspective that you don't often get in the headlines, and I certainly appreciate that. Thank you, Brian. And thank you all for listening. For more information on this and, of course, many other topics, make sure to head to our website, cycleframework.com. We'd love to have you join the CFI family. And with that, we're going to leave it there, and we will most certainly catch you on the next CFI podcast.